Monitoring your IRA contribution deadlines is an essential aspect of keeping your retirement savings strategy on track. Unlike many other financial accounts where the savings window closes on December 31st, the IRS provides a generous extension for individual retirement accounts, allowing you to make contributions up until the tax filing deadline of the following year. This window of opportunity gives you extra time to calculate your income, evaluate your tax situation, and maximize your savings. However, navigating this extended timeline requires a clear checklist of rules, dates, and custodian requirements. Failing to meet the specific deadlines or misclassifying your contributions can lead to missed opportunities, filing errors, and potential tax penalties. This guide provides a detailed checklist for your IRA contribution deadlines, explaining when you must fund your account, how to specify the correct tax year, and the steps you must take to ensure your contributions are recorded accurately. First, let us analyze the primary deadline date and the extended contribution window. The deadline for making contributions to both the traditional IRA and a Roth IRA is typically April 15th of the following calendar year. For example, to make a contribution for the 2025 tax year, you have from January 1st, 2025, all the way until April 15th, 2026. This gives you a 15-and-a-half-month window to complete your retirement contributions for the active tax year. If April 15th falls on a weekend or a holiday, the deadline is pushed to the next business day. This deadline is fixed and is not extended if you file for a tax extension. This extended window represents a major advantage, allowing you to know your exact income and tax brackets before deciding how much to contribute. During this crossover period between January 1st and April 15th, you can make contributions for two different tax years simultaneously. For instance, in February of 2026, you can make a contribution designated for 2025 and another for 2026. To ensure your funds are applied to the correct year, you must explicitly specify the target year with your custodian when making the transfer, allowing you to optimize your tax liability based on the actual numbers. Failing to specify the correct tax year is a common error that can affect your tax planning. If you do not select a year, most custodians default the contribution to the current calendar year. This means a contribution made in February 2026 intended for 2025 would be applied to 2026, potentially causing you to miss out on the previous year's tax deduction. You must verify your account statements to confirm the contribution was coded correctly. If an error is made, contact your custodian immediately to request a correction before the filing deadline. Second, we must examine the specific rules regarding processing times and the actual deposit date. Simply initiating a bank transfer on April 15th is often not enough to meet the deadline. Custodians have strict cutoff times for processing deposits, and the funds must clear the account or be postmarked by the deadline. If you are mailing a paper check, it must be postmarked by April 15th. If you are making an electronic transfer, you must complete it before the custodian's daily cutoff time. This is especially important if you are using a new custodian, as setups require additional verification days. To avoid processing delays, complete your contributions at least a week before the deadline. Online bank transfers can take several business days to clear, and any bank holiday during this period can cause your contribution to miss the deadline. If your contribution is credited after April 15th, the custodian will record it as a contribution for the current tax year, and you will lose the opportunity to save for the previous tax year, which cannot be recovered. There is no way to retroactively apply a late contribution. Planning ahead ensures your savings are credited properly, preventing a last-minute scramble. Additionally, you must coordinate these deadlines with your tax return filing. If you plan to claim a deduction for a traditional IRA contribution, you can file your taxes before you actually make the contribution. However, you must make sure that the contribution is funded by the April deadline. If you file claiming the deduction but fail to make the contribution on time, you must file an amended return to remove the deduction and pay any additional tax owed. This mismatch is a common cause of audits, highlighting the need for careful tracking of dates you initiate transfers. Finally, let us outline a practical checklist to ensure you meet your deadlines and document your contributions correctly. The first step on your checklist is to calculate your exact earned income to verify contribution eligibility. The second step is to review the annual limits and check if you qualify for catch-up contributions. The third step is to log into your brokerage account and initiate the transfer, double-checking that you select the correct tax year designation on the deposit screen. This checklist serves as your annual guide, helping you avoid common pitfalls that self-directed investors face when managing their own accounts without professional assistance. The fourth step is to confirm the transaction was processed correctly by reviewing your account statements. The final step is to report the contributions on your tax return. Traditional IRA contributions are reported on Form 1040, while non-deductible contributions require Form 8606. Roth IRA contributions do not need to be reported unless you qualify for the Savers Credit. The Savers Credit is a tax credit designed to encourage moderate-income workers to save for retirement, and you claim it using Form 8880. Checking if you qualify for this credit is recommended, as it can reduce your tax liability dollar for dollar, providing an extra incentive for your retirement savings. In summary, staying aware of your IRA contribution deadlines and processing times is essential to maximizing your retirement savings. By using a structured checklist and completing your transfers well before April 15th, you can keep your retirement roadbook compliant. By choosing the right account type and keeping your fees low, you can build a reliable savings plan. Taking a proactive approach to these deadlines ensures you capture every dollar of tax advantage available, helping build a secure financial future. This creates a repeatable system that simplifies tax season and ensures your long-term investment strategy remains on a solid foundation. Retirement Roadbook helps you navigate 401k plans, IRA rules, compound interest, withdrawal strategies, and common retirement planning mistakes. The channel turns complex financial regulations into clear, practical education so you can build a more secure future with confidence. This video is general retirement planning education, not personal financial, tax, or investment advice. Consult a licensed professional before making any financial decisions.